So even though you say there are an increasing number of startups chasing this market, the incumbents will end up having the larger slice of the pie. Why do you say that?
Well, I just look at the market now and you say the top 15 companies globally have 70% of the online ad market. And they've been growing faster than the market. Actually, if you look at last year, the top 15 companies grew 21% in aggregate and the market grew 17%. So what's left, that other 30%, is only growing 3% right now. And that's happening at a time that it's never been easier to start a company and get funded. And there's all sorts of companies out there that eventually are going to be trying to feed off that trough.
So you're saying what Facebook was able to do, the way that it was able to wedge itself into that share previously, was an aberration, that can't be recreated by a Snapchat or a Pinterest?
I wouldn't say that. I think that the advertising dollars follow users. And so those companies that come up with products that are attracting users will attract dollars. I think the key issue from my perspective is, if you look at the companies out there that have already gone public, it's taking longer and longer to get profitable on larger and larger user bases. So back in the days of Yahoo and Google, it took 3 years and 30 million users to get profitable. The next wave of companies, Twitter and Facebook, took about 7 or 8 years and 300 million users to get profitable. The next wave, it looks like it's going to take 11 years, and that doesn't even count all these private companies that are starting now. So the pool itself just isn't growing fast enough to support all of the different companies that want to feed off it.
Might you be optimistic even? Some of these companies might never get profitable, right? And there seems to be this trend, even in the smartphone business, there are a couple of strong players, Apple and Samsung, that have been able to suck up all the profit out of that, and they're getting increasingly strong. Also in cloud, you've got Amazon, you've got Microsoft, and then a lot of others who are struggling along. From the macro perspective, you get a look at a lot of different companies. What are you seeing as far as certain companies in this mobile and cloud era and advertising getting a lot stronger, while the others fighting for scraps may or may not even have businesses that survive?
Well, I think what's hard to see now is so many of the financings are of private companies. Private companies are staying private much longer. And so the visibility into just how well these so-called unicorns are doing from a financial perspective is pretty limited. What I would say is that something has to give. Either advertising related companies are some of the wind is going to come out of those sails in terms of valuation, or they may start pursuing more of a subscriber-driven business model. We're starting to see that. And I think that could offset the slower ad growth. There are companies like LinkedIn and SurveyMonkey, Evernote that have a freemium model. It's free to users, but for the power users or certain parts of their product, people will pay. And I think that's what happened in traditional media, too. If you think about it, back in the days of CBS, ABC, NBC, all ad models, and over time, cable came and the consumer started paying. Companies like Comcast and major companies today derive only about 25% of their business from advertising. So it's very possible that other models will pick up the slack, but I do think the ad model is getting long in the tooth.
How about the top down? Do you see advertising? I mean, we've had some concerns about some of the scatter markets in television. Do you think ad spending in general is robust in this country?
Ad spending in general is pretty predictable year to year. It grows in line with GNP. It's about $550 billion on a global basis, and I think it's grown at 4% per year for 10 years.
You love a 4% GDP number.
Yeah, exactly. But it tends to rise and fall, and why is that? It's because advertising is based on a projected sales level. P&G, the major marketers in this country, auto companies, they figure out what they think their sales are going to be, and they increase their ad budgets similarly, and the sales tend to approximate GNP. So the budget itself can ebb and flow with the economy, but all of these new forms of advertising like internet, they're not causing the whole market to grow. They're taking share from other forms of advertising.
And interesting, in our conversation about advertising, we mentioned Facebook, you mentioned Alibaba and Google in your post, but the name that doesn't come up is Yahoo, where of course you were president until 2009. What does that company look like after it spins off Alibaba, figures out what to do with Japan? How big is the core business in your estimation?
You know, the core business is a relatively small percentage of the stock price now. People might debate whether it's $5 to $10 per share, but it's not a very big part of the total. The challenge there is, you guys earlier were talking about Twitter user numbers and things like that. What Twitter's done in the last couple of years, even in the face of slowing user growth, is it's driven its revenue per user up more than 2 times. So it was less than $2 per user in 2012, and it's more than $5 now. Yahoo in 2008 generated $13 per user, a little above where Facebook is now. Today it's half that. And so they're increasingly having trouble monetizing their users and figuring out what ultimately is the product that's really going to make it sing, and it's a challenge.
I know it's a big question that's looming. We appreciate your take this morning, Sue.
Thank you.
Thanks for joining us.
All right, thanks for having me.